Hello, everyone. Welcome to this particular session of the African Financial Industry Summit. We will be dealing with something very straightforward in our particular segment, but something that is extremely important to figure out as we essentially try and get our economies moving beyond this pandemic in terms of restarting growth, getting employment back to where we were before the pandemic, and ensuring that we continue to grow beyond that particular point. We'll be exploring a fairly straightforward idea in the course of this particular segment. We'll be starting by asking, is the finance industry edging Africa out? We have a lot of international banks that are pulling out of many developing markets, and trade is becoming increasingly difficult in many regions around the continent. Since 2008, the number of correspondent banks have essentially fallen by at least 20%. The trade finance gap has been increasing by a fairly large percent as well. So what exactly is going on and how can we solve it? We'll explore that with my panel in the course of this conversation. You will be hearing from, among others, Jules Gankam. He's the Group Chief Executive Officer of the African Guarantee Fund. You'll be hearing from Sola Yomi Ajayi. She's the CEO of UBA America. You'll also be hearing from Brahim Benjeloun. He's the administrator, the Group Managing Director of the Bank of Africa. Sometime in the course of that conversation as well, we'll also be hearing from the World Bank. But first, to set the stage for all of us, let me cede the floor to Ngozi Chidozie. She's an advisory financial services partner at KPMG. Ngozi, over to you.
Right, thank you very much, Rama. Hello, everyone. It's really exciting to be here to speak about the state of trade finance and correspondent banking relationships in Africa, and what we need to do as Africans to focus on recovery and to take advantage of opportunities that still abound in the African financial system. I'll probably like to start, if you can share my presentation. On the first slide, I'd like to start by noting that the macroeconomic landscape globally has been quite tough, and it was really tough in 2020, with the overall growth rate of negative 3.5%. It was also very similar negative growth rates for other parts of the world. Now, in the aftermath of the great financial crisis, global banks have reassessed their business strategies against the backdrop of lower profitability, dampened risk assets and appetites, and tighter regulation and supervision. Like Rama said, of the top 20 largest banks in the world by asset size, it's only 9 banks that are present on the continent today. So for many of us as Africans, our continent has been under immense pressure over the past few years. For the most part, we have had very low average growth rates, especially for the largest economies. So if you think about South Africa, in 2020, they had a contraction of 7%. Nigeria, in 2020, we had a contraction of slightly less than 2%. Although we've had dismal stories, right, it hasn't been all stories of woe. Ethiopia, from the conversations I listened to yesterday, grew 8%. But if you look at it overall, it's been a tough environment for us in Africa. So if we move to the next slide, with this tough macro environment, if you can just move to the next slide, thank you, and the impact of COVID-19, the African region continues to face many trade-related challenges. On the bottom side, or the bottom part of my presentation, we've had large trade deficits. As of 2019, it was estimated at about 82 billion for the continent. The figures haven't come in for 2020, but it's similar in size. We've also seen the number of correspondent banking relationships in Africa drop 25% between 2011 and 2020. Now, some of the major issues that we've had or we've seen resulting from COVID is supply chain difficulties, right? So we have massive delays at ports of entry and exit for many countries in Africa. We have high cost of border compliance. We've also suffered from currency fluctuations that have resulted from FX liquidity concerns. Now, one of the biggest issues that we faced as a continent is the sovereign debt crisis in a number of the countries that that are in Africa. So higher debt levels for many countries. the twin shock of reduced global demand for commodities as well as lower commodity prices. So it just seems like it's really tough stories, and you wonder why the foreign banks would want to still remain here. But our prognosis is that notwithstanding these challenges, the stage is set for African banks to take advantage of the opportunities to address these gaps across the continent's trade value chain. So one clear opportunity that we see is for banks to position to take advantage of the Africa Continental Free Trade Association, AfTA. Now, all through yesterday and a bit of today, we talked about AfTA. Now, it has been estimated that this agreement has the potential to boost exports within the region to a tune of 560 billion. Again, African banks can position to fund the numerous trade supportive infrastructure required within the continent. If we're able to do this, we will reduce cost and time to export goods by half and boost sub-Saharan Africa GDP by more than 20 billion every year for the next 3 or 4 years. And when we talk about these infrastructure, we mean industrial parks, we mean ports. And the objective here really is to position Africa as a possible alternative or option as a global supply chain hub. Today it's China, it's India. We have a major opportunity to become that option or the alternative. What else can banks do? Banks working with governments and multilateral agencies may also seek to drive the integration of regional payment systems within the continent. This will save the region and the continent more than 5 billion in payment transaction costs per annum and formalize a significant proportion of the estimated 50 billion of informal trade, inter-Africa trade that we have. If we go to the next slide, I would want to talk about these opportunities and expound on them. But I think that I would want to leave us with what I have on the last slide, which is highlighting what I believe is the role of government. So if we can just go to the next slide, I would say that I will end this submission by highlighting what I believe is the role of government, the role of regulators, the role of multilateral partners as follows. One is to ensure that standards of behavior and engagement for all market operators, both local and foreign, are fair and easy. That's number one. Number two would be to facilitate a business landscape, including providing industry infrastructure that makes it very easy to connect the sellers to the buyers within and outside of the continent. I think the final point that I want to leave us with is that if you address the critical levers that may include the enabling legal and regulatory frameworks that are imperative for collaboration within the continent, then we'll stand a major chance of taking advantage of the opportunities that we see. I mean, these are my introductory thoughts. I'm happy now to hand over to Rama so that we can take it forward. Thank you very much.
Thank you very much for that. Much appreciated. That certainly does set the stage for our conversation moving forward. But as I said, let me just reintroduce my panel once again. We have some very interesting people on the front lines of dealing with these specific problems in detail that we're going to be speaking to in the course of the next hour or so. Jules Ngankam, of course, is the Group's Chief Executive Officer of the African Guarantee Fund, as I mentioned. Soulaye Aja is the Chief Executive at UBA America. Bahim Benjeloun is the Group Managing Director of the Bank of Africa Group. I am Rama Nyang. I'm a business journalist with CGTN Africa. Sola, let me start with you because you have this unique role where you actually straddle essentially the trade flows that you're seeing across the Atlantic. COVID-19 came along completely unexpected, had an enormous effect on economies across the continent. From where you sit at UBA, how has the pandemic affected the way banks are willing to finance trade finance and trade flows within the networks that you're plugged into?
Thanks, Rama, for that question and for the opportunity to be here today. So when you look at the challenges with trade finance on the continent, and from my perspective, I think that yes, financing of trade has actually been challenged on the continent, particularly during the pandemic, where you did have two challenges, trade between Africa and the rest of the world, and then trade within Africa, which you typically refer to as intra-Africa trade. So within Africa, we had our borders shut for the most part of the year, and there was a restriction in movement of goods and people, so that impacted trade. But along with the fact that there was a contraction in trade volumes, there was also a decline or contraction in commodity prices. Most African economies are commodity-led in terms of accretion to reserves. So the capacity of most of these nations to finance trade was constrained by the fact that access to foreign currency had reduced. But having said that, within the network, let me speak to UBA and the 20 countries we have present in Africa, while we did see contraction in volumes, generally because supply chain was significantly affected by the pandemic, both on the supply and demand side, we also saw constraints in capacity to repay, and as such, banks did have to put in extra measures to address the risk of foreign currency devaluation, which we saw across the continent, and also the credit risk inherent in trade itself. We also saw a contraction in correspondent banks willing to facilitate trade on the continent. But the flip side of this is that banks like UBA that have sub-Saharan African footprint and presence beyond Africa, like the US and the UK, were able to step in. So whereas we had the Western banks, contract in terms of appetite or left the market, we were able to step in and by the fact that we were able to support banks within our network, because we provide correspondent banking services to banks, not just the UBA network, but also third-party banks, and we were able to step in. So from our perspective, we did not experience that contraction, but we did see contraction in the market.
Jules, from your position at the Africa Guarantee Fund, in a crisis like this, the traditional models would suggest that you'd have calls on any guarantees that you provided for trade finance, and yes, there was a lot of macroeconomic damage. But how did your balance sheet make out in 2020? Jules, I believe your mic is still muted at the moment. There you go. Now you're back.
Yes, sorry. Yeah, so what I was saying is that 2020 was a particular year in the continent. We started January and February 2020. We were on the pace of the momentum that were built in 2019. But starting, I would say, from March to June, we saw like a huge drop in the volume of transaction that we used to do, and then and then luckily, I would say July, as most of the countries started to open the borders, things started also to come back, but not at the level that we've experienced before in 2019. What I would say, based on the experience that we saw at ADF, was mainly the fact that most of the banks, they decided to concentrate or to focus mainly on their existing customer. So there was not like new business, but they say, okay, how can we manage the existing portfolio or customers? So they've approached us and see what type of instrument we have to see how they can mitigate the risk mainly for the existing customer, and also to see what other type of measure we can have. I think the trend we really saw during that period of time was mainly for the bank to restructure the existing loan and to give a kind of oxygen to most of the SMEs. So what they did was maybe to extend, for example, the maturity of the loan. In some cases, to give them a kind of loan holiday. So they just stop the repayment, the monthly repayment, and say, okay, you can start paying back again maybe in a few months' time. And also some company, what they were kind of looking for was mainly to have a kind of top up on top of the existing loan. So, and this is where we've worked with most of the bank to see how we can assist them to work on that. But I think the main challenge we really faced was like the widening of the perceived risk, because there is that perception gap that is already there, but we've realized that during this pandemic, if the gap was already big, it just became a bit wider. And then the main challenge was, how do we address this widening of the perception risk?
Indeed, and I'm sure we'll come back to that in a few minutes or so. Brahim, let me come to you because I'd like to usually start these conversations with this big picture, top-down views of where we're coming from. Yes, trade finance is important, but from where you sit in Morocco, what's the situation like? How are you dealing with the damage, the economic damage that's been imposed by the pandemic?
Very frankly, Morocco has witnessed a resilience in every aspect of its activities, not only the banking system. I think one of the strengths of Morocco was governance. There was absolutely a complete understanding between private and public authorities. There was a weekly meeting between ministers of finance, industry, the chairman of the Moroccan Association of Banks, who is our chairman, also the governor of Central Bank, so that overall, when you look at more specifically the banking sector, there was a resilience. Absolutely, it was reflected. Indeed, there were drops in net results of different banks. For our part, we'll be having our board meeting at the end of the month, so I'm not allowed to talk about it. But for overall, there was indeed a drop in the net results of the various banks, and also more globally, on the macroeconomic terms, the recession is between 6 and 7%. But still, we have witnessed, because of government-backed loans, we have seen a growth in loans, for example, throughout across the country. I'm talking about Morocco. Inflation is subdued, thanks God, and it has been the case for the last years. Yes, indeed, trade finance and finance overall, I mean, export and imports of Morocco more specifically, of course, were hit. But we're more looking forward to 2021. Once again, our belief, and I'm citizen of this country, that Morocco has shown in the management of the crisis absolutely a very interesting results, because here again, and probably it's one of the recipe of success about which we should think of for Africa, is when you go across the different legal boundaries between private, between public, between those who consider that they're here only for short-term views or short-term profits. When you look at the fundamental sense of what you're doing, at the ultimate interest of the collective fate of the country, I think that Morocco has shown that. It also is reflected in the vaccination campaign. Morocco is ranked among the first 10 countries throughout the world who have massive vaccination. So I think that we should bear in mind that one of the recipe of this resilience stems from the fact that private banks, public-owned banks, public authorities, the patronat, association, everyone, I mean, put their hands in order to go to the same goal, saving jobs, saving the economy. And Moroccans were disciplined in terms of lockdowns. I think that there is even a renewed trust in authorities, in the Makhzen, which is I would say the base of the governance of this country. And this is very important as a case, as Morocco as such.
Right. Let me come back to, I think, arguably one of the biggest things that we all struggle with in media, in finance. And Jules, you pointed to this a little earlier, the gap between perceived risk on one hand and actual risk on the other. To give you a simple scene setter story on this, I remember the last time we had the Ebola outbreak in West Africa, that was basically just in 3 countries. But you'd speak to people outside the continent and they would have this impression that the entire continent is on fire, that something wrong has gone on across the entire continent. And that really it's illustrative of this perceived risk problem that we're all struggling with. Jules, let me start with you, and this will be a free-flowing conversation. So, Brahim, Sola, if you want to jump in, please do. Why does this gap still exist? There's so much data that proves that Africa is no more risky than virtually any other place to do business. Liquid Telecom just raised a bond at 5.5% coupon rate. I mean, why does this gap still exist?
Okay. Yes, thank you. You said that there is so much data, but allow me to disagree. One of the main challenge that we are facing in Africa is mainly the asymmetry of information. When we talk about the risk, the way we look at it is at several levels. The top level is the sovereign risk at the country level, and then you have the banking sector risk. Now we go to the corporate, the SMEs, and the individual. But I would say we are still facing a big challenge in Africa in terms of having access to information. Because most of the time people are saying, okay, the bank, they don't want to finance the activity, but they also want to know the type of risk that they are taking. But definitely we have a huge lack of information in the continent, historical information, even the quality of the methodology. I'll just give you an information. In 2013, the GDP of Nigeria was kind of revised up by 90, the GDP, because the economists, what they used to do at that time, they were ignoring like a huge part of the economy, where you have the movie industry, the music industry, the IT, the e-commerce. And then as soon as they realized that there is a huge part of the economy that we're not taking into account, they realized that Nigeria was the largest economy in Africa. So having access to data, the type of methodology that you are using is still like a real challenge. And then now when you take into account the fact that we have the informal sector, and let's not forget that even in those methodologies, we have a lot of qualitative data. When we talk about, for example, the political risk, how do you assess it? You have different methodology, but what I would say is that the perception risk is still big in the continent, and this is why AGF play a huge role, because what we are trying to do at AGF is to say, even if the financial institution, they are not very comfortable with the perceived risk, we are happy to work with them. And then over time, they realize that, in fact, the gap was not that big. But at the beginning, we need to give them that comfort so that when they realize that, in fact, that the gap was not as big as they expected, now we can work on maybe our pricing and give them a lot more comfort.
Brahim, do you want to come into this conversation?
Yes, thank you. I'm really keen on this issue, and it would be my motto, if I may say. I do believe for Africa that we should, how could I say, militate for a new reassessment to the African risk. The African risk is overestimated. I think that this disruptive approach that we are advocating should be applied to those rating agencies who are still focusing on some key indicators, GDP, for example, whereas probably because of this COVID post-era, we should look at the innovative potential of our countries, technological potential. We should look about the availability of talents. We should look at the progress in governance. We should talk about those who are in energetic transition, the fact that we're also adhering to this common objectives of climate change, etc. I think that here, and the same thing for banks or for any those of our corporate which are rated. This indeed, there was a flight to quality, because whenever there's a crisis, there's a flight to quality, and there was a flight to these less riskier countries. But in terms of corporate, we should not only rely on financial rating. There's also extra financial rating which could overweigh, which could compensate for some financial weaknesses. I think this disruptive approach, and this is where African Union, this is where the fact that a collective Africans who have faith in the continent, because it's let's take about it very frankly, it's more a kind of the very best sense of it, political convictions that should lead us as economic operators to keep in mind, even if we are having a private purpose, following a private purpose, to position ourselves in a more global framework. And this global framework, of course, probably when at the third question, I may elaborate, not not to monopolize the floor, but very important disruptive approach in every single domain, be it in trade finance, be it in corporate finance, be it in an industrial field. I think that it's an opportunity for us because of this crisis to absolutely take a new approach of anything we're doing. And this is why this kind of conferences, but also all the fora when you have public, private, when you have regulators, should really look at these agendas that we should look at in order to enhance the visibility and enhance the quality of risk of Africa.
Indeed. Sola, from your perspective, as from where you sit at UBA America, how do you assess that risk argument? Because on one end, there are those of us who say, look, the risk is greatly overstated, and on the other end, there's also say, well, the story's a bit more nuanced than that.
Okay, I think from where I sit, I may have a bit of an advantage over the next institution in that this is an African institution and we understand the intricacies of Africa. Naturally, when you look at the data out there, it's not very complementary to Africa. When you look at the macro variables, when you're assessing risk, there are a lot of reasons for you to say, oh, there's a lot of risk out there. But understanding Africa and how things are done in Africa, when you bring that to the table, you do realize that the risk is significantly exaggerated. Over the various financial crises we've experienced on the continent in the last 2 decades, you find that African institutions, they do pay their obligations. There might be need for a bit of restructuring here and there to address, temporary challenges in the system, but they do honor their obligations. So indeed, that risk is significantly exaggerated. But as an African institution, UBA America does not work in isolation. We do not think that, oh, there is risk in Africa. We're an African institution. We understand Africa. So our business model here in the US is actually to support African businesses, African institutions. So we take into consideration those peculiarities in each country that compensate for those risks. And we account for that in assessing the risk of our clients in the continent.
Indeed. I'd like to move the conversation slightly in a different direction and to bring in the perspectives from international financial institutions. In this particular case, the World Bank, Hafiz Ghanem is joining us from Washington, D.C. Hafiz, good to see you on this session. What are your initial thoughts on the conversation so far?
Thank you, Rama. It's very good to be with you and with this very, very interesting panel. I believe that the perception of risk in Africa is exaggerated. But I mean, we have to deal with perceptions. Often perceptions are as important or more as reality. But we need to understand what is driving that. What are the risks that people are looking at? Well, there's several drivers of this. The first one is people say, well, there are all those regulations in Africa that change. There's not enough infrastructure. Doing business in Africa is complicated. There's too much corruption. The macroeconomic situations in many African countries is very volatile. There are issues around property rights. And so on and so forth. So these are the reasons why people think that Africa is riskier than elsewhere. Now, what I also like to remind my friends who are not Africans and who think that Africa is so risky, that even if Africa is risky, Africa is also a part of the is the continent that provides greatest opportunities for profits today. Whether you look at Africa's young population, it's a huge market. 1.3 billion people. That is the size of India, and a much younger population, very dynamic, natural resources. So doing business is not about avoiding risks. It's about managing the risks and mitigating the risks. Let me talk a little bit about what can be done to mitigate risks in Africa, and maybe what international institutions like my own institution, the World Bank, and others can do and are doing to mitigate the risk.
Absolutely, because that sovereign risk argument always comes into the picture, doesn't it?
Exactly, and I think we operate at 3 levels to help reduce risks and to help also encourage investors to come to Africa. At the first level is dealing with the infrastructure challenges. It is true that without access to the internet, without access to the digital economy, without connectivity, it is difficult to do business today. And if you look at the 25 least connected countries in the world today, 21 of them are in Africa. So it is imperative that we deal with the digital divide. And we at the World Bank, working with the African Union actually, have put together a program, an investment program, to reach universal access to the internet in Africa by the end of the decade. Infrastructure, again, electricity and power is an important challenge. I mean, I lived in many different countries in Africa, and nearly everywhere I lived, whether it was in Abuja or in Tananarive in Madagascar, I had to have my own generator. You cannot build a business, especially not a manufacturing business, if you're going to be using generators and diesel fuel and so on. So again, working with the African Union, we need to achieve universal access to electricity. Today, only 40% of Africans have access to electricity. And even those who have access to electricity, it's often theoretical because you have all of those brownouts and issues. So this is, I said, 3 areas. The first area is the dealing with the infrastructure challenge. The second area is actually working with African governments to make sure that they put in place a reasonable regulatory and legal framework that encourages business and encourages investment. And that we do on a regular basis. We, the African Development Bank and others, trying to help the governments in terms of the regulatory and legal framework and the whole environment for doing business in Africa. So that is the second area. So infrastructure regulations. But then we also have the IFIs in general, not just the World Bank, but the African Development Bank, the IFC, and others. We have specific instruments that often the private investments are not aware of. So to help shift the risk for the investors.
Why is it that they're not the potential market? Why are they not aware of these instruments?
Well, I mean, it's because to be aware of those instruments, you actually have to first decide to make an investment and then start looking at it. So if you're already worried about going to Africa, you're not going to look for those different instruments, and it's a bit our role. That's why I like to come to meetings like this to inform people that there are instruments that help reduce the risk. For example, one of the biggest risks that we were talking about electricity and energy. Why aren't people coming to invest in? There's a lot of demand for energy. Why aren't people? And there is a lot of opportunities for solar, for example, or wind, for renewable energy in Africa. Why aren't enough people coming to invest in electricity in Africa? One of the reasons is that people are worried that they will be selling to the grid and that they will not be paid. So one of the things that we do and others do is to provide payment guarantees to private sector projects. So there are many sources of ways of guaranteeing the private sector projects. For big projects, we provide the guarantees directly. I can give you an example right now of a project that we're working on in Angola, which is in Luanda. It's a huge water project. And that is the example is this is a public sector company, an SOE. And there we're actually able to provide the guarantee to the SOE itself.
Right.
To the water company so that it can borrow from the banks, from commercial banks.
All right.
So we provide guarantees to the banks that who are lending to invest, to allow this SOE to invest in water in Luanda.
All right.
We have,
Mr. Ganem, I'm going to have to jump in there very briefly because we're trying to manage our time a little bit. But thank you very much for your insights on this matter. I'm going to get back to the panel because some of the ideas that you're putting forward here, some of the solutions you're putting forward are things that either they have deployed or they're thinking about deploying or they're experimenting with in a bit of detail. Brahim, if I may come back to you on the question of cross-border payments, because now one of the big stories around the continent is, yes, we've set up the Continental Free Trade Area, and yes, there's this disentanglement that we're seeing between large Western financial institutions and the economies on the continent as well. But what sort of infrastructure do we need for payments, for KYC, for insurance, to essentially make sure that the CFTA actually works as intended?
I think we as Pan-African banks play an important role in terms of integration and in terms of helping this cross-border finance and cross-border trade flows. I really wanted to insist on something to which you referred just before. I'm sorry, because it's so important about the African risk, the responsibility of banks to enhance the African risk. How could we do it? I think that here again, and it will help also develop the cross-border inflows, investment flows, and also trade flows, is how we could de-risk, how we could enhance the risk and de-risk. I think there are a certain number of initiatives. I think that share of information through credit bureau will mitigate credit risk. I think prudential rules across a region will because there are 10 types of risk. Prudential rules in terms of concentration risk, for example, in terms of liquidity risk. These kind of things will help. Indeed, a harmonization of regulation throughout a region will help indeed enhance the trade flows. Here again, we have to adopt a disruptive approach, and we as operator can do it, and we for our part try to do it. For example, in terms of what we call blended finance, I think we should look for products which should at the same time include loans, but also things that you can bring from multilateral institutions like subsidies, or in order to help to capacity building or technical assistance. For example, if you want to help the ecological transition for renewable energy, for water management, or for these kind of things, I think blended finance, when you combine multilateral fund, private funds, DFI, bilateral funds, and with this aspects of subsidies, will help indeed enlarge the access of finance and help indeed in the regions where we are the cross-border finance and also investment flows.
Let me just interrupt that briefly and bring Sola into this conversation, because this is arguably a question to both of you, because a lot of the things that we're trying to deal with here, like say quantifying risk for clients across the continent. You're both in charge of institutions that are running operations across very large parts of the continent. You have a granular, deep understanding of both the macro environment and what clients are actually doing and their risk worthiness. You've got decades of data. Is this something perhaps that UBA America and Bank of Africa can work together, put together a common platform that says, hey, this is what we have on risk assessment for clients in country X and Y and Z. And that perhaps could eventually end up de-risking the entire profile. Sola?
Thank you, Rama, for that question. I think you're very spot on that. The need for regional banks like UBA and Bank of Africa and other players on the continent to come together to collaborate to develop infrastructure for the continent. I think the need is there, and it's something we need to take up that opportunity as leaders in Africa. There is the need to share data, so we're not replicating resources and efforts. There's a need to share data. There's a need to work towards common settlement platform for currencies on the continent in order to make the African Free Trade Continental Agreement successful. Because today we all have different currencies. Yes, there are 1 or 2 economic blocks in the region, but we have over 20 currencies on the African continent. And to be able to settle trade between ourselves, we first of all have to, convert into the US dollars or something. But we can set up a common settlement platform on the continent. Supranationals like Afrexim have initiated this. I think we all need to buy into this and make this happen. We also can work together to have common credit bureaus, whereby we can get data to make it easy to make credit available to African institutions. Because the key barrier to accessing credit is lack of data, lack of credible data about, an obligor's capacity to repay and obligor's historical behavior. So yes, institutions like UBA, Bank of Africa, and other large regional institutions do have a role to play to come together to build that infrastructure.
Brahim, is that something you would?
Yes, Rama, I do subscribe to all the ideas put forth by Sola. Indeed, what she said, I would add also, with the regulators. For example, we as Pan-African, we are present in 20 countries in Africa, but also 12 outside Africa. There are a college of supervisors, and that means that there are agreements between supervisors, and they meet us, we Pan-African banks, for example, here in Morocco, every single year. And this is also an opportunity to share data between regulators and help us set up, as Sola said, these regional credit bureaus. It's essential. And I would like also to insist on the fact that we should leapfrog absolutely in terms of technology. Here again, we as bankers, we invest in technology. I think the blockchain is one of the promising technology for us in order to represent a kind of engine of trust between we operators. And that will help indeed enhance the cross-border flows of investment and trade flows. And lastly, I think in the name of a kind of corporate social responsibility, and I would like to say that we'll let Juliet to talk about it. I'll give just a hint to the rating we've just received in early March. I think that we operators should put on the top of our agenda a fantastic agenda that the CFTA represent. I think that should, set our action plan within this framework and say to what extent I will be contributing to the enhancement of we private sectors and we as a community of banks. And
indeed, it takes us all into the argument about what is the role, what's the purpose of the business, doesn't it? But Jules, yes. Let me come back to you. There's something you said a little earlier, that there's not enough data across the continent. But from where I sit, I look at my banking relationship, for instance. My bank has at least 15 years of data on my transactions, my habits, and so on and so forth. My telco has even more granular data on my spending and investment habits. For a lot of businesses, it's arguably the exact same thing, because what consumers will say is, hang on, if you have 5 years of data on me, and yet my risk profile is still is deemed to be exactly the same. That doesn't sound like a data problem. That sounds more like an analysis problem.
Yes, indeed, Rem. Yes, indeed. I think that we banks that I'm talking about, not in the name of all banks, but we banks have a lot to do in terms of data analysis. That's absolutely one of our very next frontier and here we are addressing, now that the COVID came because of digitalization, one of our key action plan is related to data analysis. Is indeed, how could we also have some extraordinary data also with the telcos without seeing how bridges could be how could I say, set between all these telcos, between insurers and between banks. And this is where a voluntarist action should be taken by regulators, by talking to themselves, by seeing how we can harmonize regulations between these three actors, because one of the frontiers of new finance is linked to that.
Let me just move back to Jules. Jules, what do you make of all of this conversation, especially when it comes to data analysis?
Yeah, you just gave your example, which is a good example. I think the first question is how many, like in terms of percentage, what do you represent in the population? I'll just give you like a very quick example. How many countries in Africa out of the 54 have a well-functioning credit bureau? How many? Less than 10 in the entire continent have a well-functioning credit bureau. That is already a big challenge. Now take the collateral registry. So the collateral kind of registry is like, it's an entity where you can go, for example, and register your property, right? Like your land title and all that. How many countries in Africa, they have a well-functioning collateral registry where in fact you can go and then they will assess the value of your collateral. They will tell you what is the liquidity value today in case you want to liquidate. How long is it going to take? At what value? That is still a huge challenge. It's a huge challenge in the continent. Now, go now to the informal sector. You know, we talk about the SME. What percentage is represented by the informal sector? How do you get all those data coming from the informal sector? So yes, you know, in some specific cases, yeah, we have like 15 years of data and all that. But what I would say is that when you look globally, it's still really a challenge. And this is what I was even telling earlier when I took the case of Nigeria. Take a country like Nigeria. They misrepresented the GDP for more than 20 years. How about now the corporate? How about the SMEs? If at the country level, they were misrepresenting the GDP for a such long period of time. So the data, we may have it. And then even the habit. You know, we have some cases where we had SMEs. They have 3 financial statements. They have one for the taxman, they have one for the banks, they have one for the family member. Now, how do you reconcile all of that? The data may exist, but how accurate is all this data? And this is where now a lot of effort has to be done to say, like, as all the panelists said earlier, the credit bureau is key. The collateral kind of registry is key. Formalizing the SME, making sure that they are part of the banking system where we can actually monitor all the flows. That one is also key. And lastly, leveraging on technology. Today we have the blockchain technology, which is something just fantastic, but we need to leverage on that. Data is something, quality of data is
let's put that into concrete terms, because a lot of the telcos coming out into the market right now, like if you use Kenya, for example, where I believe you both are, Safaricom arguably is the one single company that probably has the most granular details on people's transactions and financial habits across Kenya. How then can AGF work with a firm like Safaricom to use that data to develop a much more granular picture of risk in a country like Kenya?
Okay, you know, earlier I said, when you talk about the credit risk, you have several layers. You have the sovereign risk. At that level, you need to make sure that you have all the data that are needed. Now you go to the banking sector, and then now to the corporate, and lastly to the individuals. Yes, today working with Safaricom maybe will help us to gather all this data at the individual level. But now, as we go now to the corporate level, it's a different story. As we go to the SME level, it's a different story. And as I was saying earlier, I think at this level, it's not just a challenge coming from Safaricom, coming from ADF. We need to engage. We need to engage the policymaker today to create an environment where we can have more credit bureaus, where we can have more registry, where all the banks can have access to have information, all this type of data. Safaricom, they are doing their work, but they will cover just a portion of the population. And we are talking about Safaricom. This is Kenya. Now, how about other countries in Africa? You see, so yes, things are moving, but when you see it globally, you realize that you have some countries, they are far ahead, but some, they are very lagging behind. And then I believe that when we will be now in a position where we can have like the same development that is happening, let's say in Kenya, in Tanzania, in Uganda, in West Africa, in Central Africa, then we will be now in a better position to say, okay, we have enough data to be able to understand very well the behavior of our customer, the credit worthiness.
Indeed. Let me move on to the last element of the conversation that I have planned here. I've heard conversations around, or rather ideas around fintech being a solution to the problems that we're facing in assessing risk, in being able to deliver the financing that SMEs do require. But to date, I haven't heard anyone talking about bringing government in terms of bringing capital into the picture as part of the solution to at least making trade finance a lot more accessible, because this gap just keeps growing and growing and growing, as Ngozi mentioned in her presentation. Jules, do you think governments have a role to play in trying to close that gap, even with all our limited fiscal space?
The first role is the policymaker. Everyone else will follow. The first actor to play this role, we talk about the infrastructure, access to energy, access to market, the AFCTA. This is not a challenge that will be managed by the private sector. The government, they have to play that role so that they facilitate, they create the ecosystem, the good environment for the SMEs, from the banks, from all the other actors to be able to kind of evolve in this type of sector. But who has to set the environment first? This is the government. But if they don't do it, the banking sector, the SME, they will still have to work, but not in an optimal way. If you want that to be optimal, the government, they have to play their role.
Brahim, Soler, what do you make of government coming into the picture? Do we need them to to have some capital, to have some skin in the game in order to essentially bridge this gap, for lack of a better word, in trade finance?
Soler, of course.
And then Thank you, Brahim. Okay, so, well, definitely government has a role to play in terms of scaling up the SME sector in every country. SMEs cannot thrive without government intervention. So government does have a role to play in terms of policymaking and regulation, but more importantly, also has a role to play in providing subsidy and also in providing capital through development banks that will have programs available to small, medium-sized enterprises through which they can access, funding that is affordable and funding programs that are less restrictive, because we do know that the behavior of SMEs will significantly vary from the behavior of structured institutions. So government has a significant role to play. And in so doing, government also has a role to partner with the financial institutions in rolling out these programs, because the financial institutions have the network. They are on ground, they're closer to the SMEs. Government is further away. So government does have to partner with these institutions in rolling out these programs and in making this funding available to SMEs.
Brahim?
Yes, indeed. I would speak about a kind of PPP, which doesn't mean the corporate finance PPP. It is essential, and we've witnessed here in Morocco a start of a promising project with the SMEs financing. For the first time ever, the head of state, the King of Morocco, before the parliament, stressed the importance of SMEs and asked banks, the Central Bank of Morocco, but also the patronat with the Ministry of Finance, to think of a new system so that to enlarge. It was in 2019. And indeed, there was a launching of a very promising product called Intilaqa, which means the start, and all the banks went in. Why was it the start? Why I'm talking a start of a success and not a success? Because COVID came, and of course there were other products very essential that was launched in order to save, as I said, jobs. Is the fact that there was first subsidized interest rates, the fact that there was guaranteed loans from the state with the banks distributing guarantee loan, and more importantly, the fact that we considered as Morocco that finance was not sufficient, money was not sufficient, extra financial accompanying the SMEs. And this is where the Minister of Interior of the country, the Domestic Affairs Department, through its what they call the Centres Régionaux d'Investissement, investment regional centers, came enhanced with banks in order to create an ecosystem made of former auditors, made of retired bankers, made of people like this, in order to accompany these entrepreneurs who often, I'm talking about auto entrepreneur or new start of entrepreneurs, etc. And this is how we address the issue. Of course, more globally, SMEs start with the same definition within the country of what an SME is, and this is how we consider that the financing of SME is not only a question of capital. It's a question, as I said, of extra financial accompaniment. It's a question of governance. It's valid not only for private sector, but also for governance. We were talking about risk. I'm sorry to go back to that. The sovereign rate and everything. We see, for example, just a word, Rwanda, which has a premium risk, which is lower than other countries because of that, because of its good governance. And this is how the state should be exemplary in the way it runs its affairs, but also coming through funds, coming through subsidized funds, etc. Indeed, and that's what I call the new PPP, a new private-public partnership.
So in short, build systems that work and the rest will follow.
Absolutely, and we've shown the way in Morocco and with the Intilaqa products, which will recover after the COVID.
Okay, so let's bring this conversation to a close. Yes, there's a problem with trade finance. SMEs that do need it are not getting it. We're seeing correspondent banking relationships close. Give me, in about a minute or less, your big, crazy idea on how we can fix the trade finance problems that a lot of SMEs are facing across the continent. Sola, you'll go first, then Brahim. Jules, you'll close us out. Sola.
Okay, so from my perspective, in terms of finance and trade and making trade finance more accessible, I think we need to eliminate as much as possible the middlemen. There are lots of middlemen. Trade, you can find an importer based in South Africa that is importing from Kenya and will be asking for confirmation by an A-rated international bank. Those are levels you do not need. The levels of banks, the capacity of banks on the African continent has strengthened significantly in the last decade. We do not always need that extra intermediation by a third party. It simply adds to the cost of doing business and makes access to trade finance, more challenging on the continent.
So in short, we need to trust our own. We've developed the capacity, the banks are there, we need to trust our own.
Definitely.
Absolutely. Brahim?
There was a formula, this channel by the highest authority of the country, Africans should more trust Africans. Indeed, I do subscribe to this idea. I would say one of the crises, if I may say, is to find how we can even innovate in products where when you can sell here again, a kind of a blended trade finance products, something which has not only to do with the classical product, something which could here again channel funds from subsidized, from public, so to de-risk, to enhance the risk of the country involved. I do believe guarantees, I do believe insurance products should enhance the risk. We should find a way where you will see actors not necessarily belonging to the area and coming to give funds in order to intermediaries who will then do the transactions like we bankers. I think there is something to see around this. Here again, PPP, the fact that you bundle, that you blend products and not straightforward. It's like what we say about SMEs, not only money, coming with extra value with it.
All right, Jules, you essentially deal with risk on a daily basis. You understand this subject a lot better than we do. Give us your closing comments. How do we solve this issue?
Yes, so what I would say to solve the issue, there are two things, what I believe. The first, how do we reduce the asymmetry of information between the lender and the borrower? That is a key issue that we need to address. And secondly, how do we develop more risk mitigation instrument? Today, this is the role that ADF is playing, but definitely we need more risk mitigation instrument. Mitigate the credit risk, mitigate the FX risk, mitigate the liquidity risk, mitigate the market risk. Today in Africa, this is one of the biggest challenges that we have. The continent doesn't lack money. We have a lot of money in Africa, but what we are lacking are instruments to create more liquidity, to give more comfort to the market participants.
If you were a policymaker, say sitting with policymakers from South Africa, Kenya, Nigeria, what's the one thing you'd like to see from all of them to actually deal with all the risks that you've mentioned, from credit to liquidity to market risk?
Definitely is how do we mitigate those risks? You saw what were the volatility just recently with the Nigerian naira, with the Kenyan shilling, with the currency in Ghana, the Cedi Ghanaian. What instrument do we have today? You go in the market today, you see the bit of the spread between the bid and offer is huge. It's even kind of discouraging. So if today I was a policymaker, that would be to see what can we do concretely to develop risk mitigation instrument, because the bank, they're not here to lose money. The bank, because sometimes we say, okay, the bank, they have to finance the economy, yes, but at the same time, they don't want to lose money. How can we now develop those instruments to work together with the banks so that they can play their role?
Indeed. We'll have to leave it there for the time being. We have run out of time for this session, but I would like to give a very strong thank you to all of my panelists for this engaging discussion in the last hour. Jules Nkamp from the Africa Guarantee Fund, Brahim Benjelloun from Bank of Africa, Sola Yomi Ajayi from UBA America, and of course, a little early in the session, Hafiz Ghanem, Vice President at the World Bank, was also with us, and at the very, very start, Ngozi from KPMG. You've been watching this particular session on trade finance. We thank you for your time and attention. The next session is starting shortly.